If you're a day trader, then you know that when the market slows down, as so often happens in the summer where trading volumes are lower, there can be days that are just plain painful because there's so few opportunities for a big move in a stock or an ETF that can give us a strong profit opportunity. I'm the head trader of SMB Capital's options trading desk here in Manhattan, and on those same days that the day traders on our desk are frustrated by the lack of movement in the marketplace, there are strategies available to the options income traders on our desk that actually create some of our best opportunities for profit all year, ironically. In today's video, we're going to go over an example that took place just this week, which I'm pretty sure you're going to find fascinating, so stick around. Hi, I'm Seth Freuberg, and I'm the head trader of SMB Capital's options trading desk. SMB Capital is a proprietary trading firm located in Midtown Manhattan, and we provide capital for options and equity traders from all over the world, trading both remotely and in our offices here in New York City. Now, I'd like to suggest that you click on our subscribe button right now so that you don't miss any of our free trading videos that we produce for traders and investors all over the world. They're really very valuable. Now, at least in the Northern Hemisphere, it's summertime, and while it's been a crazy year so far, in most years, there's a trading lull that takes place in the summer. I'd like you to take a look, for example, at July of 2019 last year, and you can see that the S&P 500 index traded in a very thin trading range of 75 points, which is about 2.5% of the value of the SPX index for almost the entire month of July. So in a situation like that, where the market's sluggish and hardly moving at all, a well-rounded trader will have a strategy in his playbook that can make a profit in sluggish environments, and that's what we're going to be discussing in today's video. Now, before we get into that, though, we need to make sure that everyone watching this video has a handle on how index options work. If you already know the ins and outs of index options, then don't worry, this is going to be quick, and then we'll jump back into this strategy for sluggish markets. Okay, so now almost all of you are probably familiar with equity options, where a call buys you the right to buy 100 shares of a stock at the strike price of that option anytime before the option expires, and a put option entitles you to sell 100 shares at the strike price of the put before that option expires. But there are also index options, which work similarly to equity options, except there is no such thing as 100 shares of an index like the S&P 500. You can't really buy or sell 100 shares of an index, but what you can do is get paid in cash $100 per point if the index expires above the strike price of an index call that you buy, or alternatively, you'd be paid $100 per point for each point the index drops below the strike price of your index put. So for example, if an index is trading at 3150 and you buy the 3160 call, if the index closes at 3165, you would receive $500 in your account. If the index closes at 3610 or lower, on the other hand, your call expires worthless. Now, on the other side of the ledger, if you buy a 3135 put and the market sells off to 3125, you'd make $1,000. But if the market just sold off to 3135 or higher, the put would expire worthless. So those are the basics of index options. And remember, you can buy options, but your broker will allow you to sell options as well. And your broker will allow you to put together combinations of options. In other words, option strategies that involve both short and long options purchased in a way that's advantageous to you as a trader. On Monday morning, July 6th, the SPX index opened at 3174, and on that morning, a trader could have entered into what is known as an iron butterfly trade to options income traders. So in this case, the trader, as you can see, could have sold both a call and a put at a strike price right at the market price of SPX, which is 3175, for options expiring that day. So this will be a one-day trade. And then for protection, the trader would move up 50 points to the 3225 call and down 50 points to the 3125 put and go ahead and buy those. Now, the first thing we'll want to do is to break down the cash flow implications of this trade so you can understand why a trader might put together a combination of options in this way. So we paid 25 cents for that long call at 32.25, as you can see. And remember, that call is worth $100 per point above a closing price above 32.25. And so you multiply that by $100 for a total cost of $25. Now we sold that 31.75 call for $9.42. And so as you can see by the calculation, that brought in $942. And we also simultaneously sold the 31.75 put for $9.41 for a cash inflow of $9.41. And finally, we buy the 31.25 put protection for 78 cents, which therefore costs us a total of $78. So when you net everything down, you end up with positive cash flow of $1,780. And the amount your broker will require for this trade is $32.20. So that is the amount of capital you'd be putting to work to enter this trade. Now, before we get into how this trade turns out, and more importantly, why, I wanted to let you know that there are many sound, viable long-term techniques for trading options for income. And in fact, we're currently running a 2-hour free intensive workshop at the moment where we'll be teaching you 3 of those strategies that real professional options traders use, including a really simple but incredibly effective strategy that some of the greatest investors in the world, like Warren Buffett, use all the time, plus an options trading strategy that has a statistical 80% probability of profit month in and month out, plus an option strategy that you can employ with a stock that you like, where you'll make your target profit whether the stock goes up, goes nowhere, or even goes down a small percentage. So if those strategies would be of interest to you, then you should check out the free options class that we're currently running. Just go ahead and click the link that should be appearing now at the top right corner of your screen. That will open up the free registration page in a new window, so don't worry, you won't lose this video. Or you can just head on over to optionsclass.com to register for this free intensive workshop. It's a rare opportunity for retail traders and investors to learn directly from Wall Street traders, but that's exactly what you'll be getting through this free online workshop. So click the link to sign up now and don't miss it. Okay, so now returning to the one-day iron butterfly trade, let's now move to the end of the day to see exactly how these options would have been valued, because this is the last trading day for these options, and so their settlement price is based on the closing price of the SPX index. And as you can see, the SPX index closed at 3179.70, which is 4.7 points above the short call strike. So let's first break down the cash flow of how these options will be settled so you'll see how this trade turned out. Well, the 32.25 call, that was way above the market when it closed, so that one just expires worthless. But the 31.75 call, well, remember that the owner of that call, the one who you sold it to, he gets $100 for each point above 31.75. So as you can see, your account will have to pay the call owner. It will be debited $470 because it expired $4.70 in the money. And as you can see, both puts, the 31.75 and the 31.25, expired with no value because they only pay off if the index closes below the strike price of those puts, which obviously didn't happen. And so those are also worthless. So what that leaves you with is one option that causes you to pay money and the rest expiring worthless. But remember, you originally received $1,760 for entering into this position in the first place. So what happens is that after subtracting out the cost of the payment you had to make under the 31.75 call, you end up with a final profit of $1,310. You see, the only question with iron butterflies is how much you will owe under either the short call or the short put, because unless the market closes exactly at 31.75, you will owe something under one of those two because it's binary. The market has to close either above or below 31.75, as those are the only two possible outcomes. In fact, there's actually a range of outcomes where you would make a profit on this trade. As you can see, at any price above or below 31.75, which is where we sold both the short call and the short put, as long as the SPX doesn't move more than 17.6 points above or below 31.75. Options brokers and options analysis software vendors, in fact, create profit graphs for you to see the potential on these trades at a glance. And the profit graph for this trade looks like this, which should come as no surprise because we just showed the mathematical basis for why a profit is made on this trade at any price between those 2 points above and below 31.75. The closer the market closes to the short strikes at 31.75, the more money the trader makes because the less is paid out under either the short call or the short put. And of course, if the market actually closed exactly at 31.75, you'd just keep all of your cash flow and pay out under nothing, neither the short call nor the short put. But that would be such a fluke, it's hardly worth mentioning. And so in this case, with the market closing so close to the short strikes, under 5 points away, the profit was terrific, 40.6% against risk capital. So the key takeaway from this video is that there is a way to make money on a slow day, and in some cases, a lot of money and a great return. It certainly is a slow day in most cases when the S&P 500 index closes less than 5 points from its opening price, and you wouldn't think that trading those days would yield very many big movers off of which a day trader could make a big score, but it's exactly on those kinds of days that a professional options income trader can pull this trade out of his playbook and be richly rewarded for his efforts. Now, just to remind you, as I said earlier, if you enjoyed this video and learned something valuable from it and would like to learn the details of 3 real-world option strategies that professional options traders use all the time, then you should check out the free online options class that we're currently running. Just go ahead and click the link that should be appearing now at the top right corner of your screen. That will open the free registration page in a new window so you won't lose this video. Don't worry. Or you can just head on over to optionsclass.com to register for this free intensive workshop. It really is a rare opportunity for retail traders and investors to learn directly from Wall Street traders, but that's exactly what you'll be getting through this free online workshop. So click the link to sign up now and don't miss it. And please don't forget to click on the subscribe button right now so you won't miss all of these free trading videos that we're constantly posting on our channel to help you to improve your game as traders.